Hello, dear viewers and students. Welcome to another lesson in accounting. In today's lesson, we're going to look up the types of discounts, more precisely, the trade discount, which is mostly covered in grade 10. Let us look at a scenario where two businessmen are talking to each other. Like one saying that with a view to attract more customers and to benefit from our suppliers, we can have recourse to discounts. And the other one pondering. Then the next question that should be asked is like, what are discounts? Well, discounts are the privileges that are received or earned or allowed or which is given, or rather which are given. The types of discount that exist in every sphere of business, we've got the trade discount and the cash discount. Trade discount is defined as a reduction in the list price of goods, that is, deductions from the amount of goods purchased on credit or deductions from the amount of goods sold on credit. Therefore, trade discount is a reduction in the list price of goods. Trade discounts are not recorded in the books, but in fact are deducted from the amount of goods purchased on credit from suppliers and the amount of goods sold on credit to customers. Let us look at one example involving trade discount. Goods purchased from John, list price 500 less 10% trade discount. So here what we can see, the list price is 500 and the trade discount is 10%, which implies if we take the list price 500, we deduct the trade discount of 10%, which is 50. Therefore, the amount that will be due to John is only 450 and not 500. So this should be carefully interpreted. Let us look at a second example. Goods sold to Tom, list price 800 less 20% trade discount. So here the list price is 800 and the trade discount is 20%. So if we take the list price of 800, we deduct the 20% trade discount, which comes out to be 160. The amount due from Tom would be 640 and not 800. This trade discount will not be recorded in the book. That is, the trade discount of 160 will not be recorded in the books. Concerning the recording in the books, we're going to look at later on in the lesson. Let us look at a question. The following appears in the books of Sam. January 10th, sold goods to A, list price 1000 less 10% trade discount. January 15th, sold goods to B, list price $2,000 less 15% trade discount. January 25th, goods returned by B, list price 200, and January 20th, goods returned by A, list price 100. This we talk about them later on during this lesson. Now let's concentrate on the first two, that is selling goods to A and selling goods to B, list price, and then deduct the trade discount. So whenever we sell goods on credit, it is recorded first in the subsidiary books. Therefore, if we consider sold goods to A, list price 1000 less 10% trade discount, we open the sales day book, write the date, A 1000 less 10% of the 1000 gives net amount of 900. It is this 900 that will be recorded in the books as sale, or rather goods sold to A. Therefore, in the sales ledger, also known as the receivables ledger, we're going to have in the account of A, on the debit side, January 10th, sales 900. Let us look up the second transaction. Sold goods to B, list price $2,000 less 15% trade discount. As we said earlier, that when we sell goods on credit, it is recorded first in the sales day book, which, if you remember, we already had goods sold to A, the net amount being 900. Now we record those goods which have been sold to B, 2000 less 15% of 2000, that gives a net amount of 1700. That is this amount that should be recorded in the books. Therefore, in the sales ledger or receivables ledger, where we already had the account of A, on the debit side sales 900, now we record the account of B, on debit side sales 1700. So nowhere we record the list price, neither the trade discount. Now, let's go back to the question again. Now we concentrate on the last two transactions, that is return of goods. If you would recall in the lessons of documents, you will find that whenever a credit customer returns goods to the businessman, those goods were accompanied by a document known as a debit note, which was used to request for compensation. Now, once the businessman is satisfied by the demand of the customer, then the businessman issues what is known as a credit note, and therefore we always say that credit note sent to the credit customer is considered to be the return inwards or sales returns. If we come back to our question, the last two transactions, goods returned by A, list price 100. These goods were sold on January 10th. This is very, very important. Why? Because if we look at January 10th, we're going to see that A was given a trade discount of 10%. So if now we're going to accept the return from A, we cannot accept on the basis of the list price, because when we sold goods to A, there was a trade discount which was deducted. Therefore, now when A returns the good, we have to adjust for that trade discount of 10%. Same thing applies for B. Goods returned by B, list price 200. These goods were sold on January 15th. So if we look at January 15th, when goods were sold to B, there was a trade discount of 15% that was deducted from the list price. Therefore, if now we accept the return from B, the account of B cannot be adjusted with the list price. The trade discount has to be taken into consideration. Let us see how we adjust for these. So, Goods returned by A, list price 100. We mentioned that they were sold to A on January 10th, where there was a trade discount of 10% if you remember. So whenever there are sales return, we record in the sales returns book, also known as the return inwards book, or you can substitute the word book by the word journal. Therefore, on 20th, A 100 minus the trade discount of 10% that was given to A previously. Therefore, we get 990. If we record in the account of A in the sales ledger or receivables ledger, you will remember that we already had A debit side sales 900. On credit side, we record sales returns 90. Once again, neither the list price nor the trade discount are recorded in the books. Let us look up the second example of return of goods. So goods returned by B, list price 200. These goods were sold on January 15th. As we mentioned earlier, the return of goods have to be recorded in the sales returns book, where we already had goods returned by A, and now we record those returned by B, 200 less 15%, that was a trade discount given to B earlier, and the net amount comes to 170. Let us see now how to record it in the account of B. We already have in the sales ledger, receivables ledger, the account of A and the account of B, whereby on debit side we've got sales 1,700, and we record the sales returns on the credit side, January 25th, sales returns 170. So this is an example where we have both the credit sales and sales return. How do we record after trade discount? So let us now close the sales table. We're going to see that A, the net amount of credit sales is 900, and B, 1,700 after the trade discount. We do not take the total of the list prices of the goods sold, the total being 2,600 after trade discount for both customers. The total credit sales for the month of January 2,600. This will go in the sales account. In the general ledger, we're going to have the sales or revenue account, and we've learned at the beginning in grade 10 that whether we sell goods for cash or on credit, the sales account has always to be credited. Which implies on credit side, total credit sales for January 2,600. Same thing applies for sales returns. The total being 260 and not the total of the list prices. So 260 is the total after the trade discounts have been adjusted for the sales returns. Therefore, total sales return for January 260, which we should be recorded in the sales returns account. In the general ledger, we already have sales account on credit side. Therefore, sales returns account will be on debit side recorded. Total sales returns for the month of January 260. Let us look one example involving purchases. What we've seen so far is examples involving sale of goods to credit customers and return of goods from credit customers. Now let us look at purchase of goods from credit suppliers. Purchase good from Jackson, list price 500 less 10% trade discount. In the purchases table, we're going to have Jackson 450, the amount after the trade discount, which will be recorded in Jackson account on credit side 450 and not the list price. Now, if we say that on December 17th, Jackson returned the goods list price 100 and the goods were purchased on December 8th where a trade discount of 10% was applied. This would imply in the purchases returns book, we're going to have Jackson 100 minus the trade discount that was given at the time of purchase, which is 90, and this will be recorded on the debit side of Jackson account 90. Therefore, the points to remember: a trade discount and cash discount, we need to distinguish between both of them carefully. In this lesson, we saw about trade discount. In the next lesson, we are going to look at the cash discount. Also, trade discount not recorded in the books, subsidiary books of the trade discount, that is how subsidiary books are being prepared, and as well as how the specific ledgers, the receivables or sales ledger and the payables or purchase ledger recorded after trade discount. So dear viewers and students, we've reached to the end of today's lesson. Thank you for your attention.